Hello everyone, welcome to the channel of Wall Street Mojo. Friends, today we are going to discuss on the tutorial of contribution margin formula. Now, contribution margin, as you can see it is written, is a measurement through which we understand how much a company's net sales that will contribute to the fixed expense and the net profit after covering the variable expenses. So basically, let's discuss on this. Contribution margin is a very cost accounting concept because that allows the company to determine the profitability of the individual products. I mean, the phrase contribution margin can also refer to per unit measure of a product's gross operating margin, calculated simply as the product's price minus the total variable cost. Okay, so this metric allows an entity to evaluate different area of business to determine which service or product line to emphasize based on the highest margin. Okay. Let's break down the contribution margin. See, contribution margin is calculated by reducing the sales price by the total variable cost, okay, regardless if the cost is material, labor or overhead. For example, if we just take in a mind map way, company XYZ, let's say it sells an item for, let's say, $100. Okay, the company incurs a unit variable direct material cost as 12. Okay, so sales is 100, material expense is 12, and the unit variable labor cost is 25. $10 of variable overhead per unit and 8 as the fixed overhead. So the contribution margin is what? The 100 that was the sales, less any direct material expenses that was 12, less the labor expense that was $25, less the 10 as a variable overhead. The fixed overhead of $8 won't be deducted. 53, that the total amount comes to $53 because the fixed overhead per unit of $8 is not considered, right? Now, contribution margin, let's consider its usefulness. See, contribution margin is used by management when making pricing decisions. This is especially true in special pricing or special order situations where fixed costs are sunk costs and should not be factored into a decision whether to accept or reject. Negative or low contribution margins indicate a product line or business segment may not be profitable. In addition to the contribution margin, is helpful to analyze the impact of different level of sales. Finally, a business can use contribution margin to resolve any bottlenecks. If limited resources are available, a business wants to contribute that scarce resource towards the most profitable items. Therefore, constraints are eliminated by awarding the most profitable items the resources. I mean, if you take the break-even or target income analysis, the contribution margin is a very integral aspect when calculating the break-even point of sales or the target level of sales. The contribution margin determines the portion of each sale that is contributed to covering the fixed costs. For this reason, fixed cost divided by the contribution margin results in number of units needed to be sold to break even. So to find out the target net income, the target amount is added to the fixed cost. Now, contribution margin ratio. See, the contribution margin is directly related to the contribution margin ratio. The ratio can be calculated on per unit basis or an aggregate basis, that is on total basis. The per unit basis divides the contribution margin per unit by the unit sales price, while the total contribution margin divides the total contribution margin by the total revenue. So the figure will result in a percentage that indicates what percentage of the each dollar of revenue is generated to cover the fixed cost. This metric is calculated by dividing the contribution margin by revenue. See, contribution margin formula, if we try to evaluate, I mean, let's get into the nitty-gritty of it. See, it is a very significant concept in every business owner should understand. I mean, and to calculate the contribution margin, all we need to look at are the net sales and the total variable expenses. So let's see the formula and let's go into the Excel. See, the contribution margin is equal to the net sales divide less any, you say, total variable expenses. You remember we had already calculated example on the same and which had solved our purpose. Along with finding out the contribution, we can also calculate the contribution per unit and ratio as we have noted. Now, contribution margin formula. Let's take a very practical example and which will illustrate the contribution margin formula. Let's say there is a company whose name is Guri Company. Okay, a Guri Company has a net sales of close enough to, let's say, 3 lakh. It has sold 50,000 units. I'm just writing units over here. Okay. of its product. I mean the variable cost of each, I'm just writing VC, that is the variable cost, is $2, and this is per unit. Again it is $2. Now find out the contribution. What we need to find? We need to find contribution, then we need to find contribution per unit, and we'll calculate also the contribution ratio. So I'm just writing the ratio, then contribution per unit and the ratio. So we'll simply use the contribution formula to find out the contribution per unit and the contribution ratio. The company has a net sales of how much? 3 lakh. The number of units sold was how much? 50,000. The selling price per unit would be how much? So let's write the selling price per unit is equal to 3 lakh, that is the net sales, divided by the total number of units. That will give us the net selling price per unit. The variable cost is $2. Okay, so let's calculate the contribution per unit. Okay, so contribution per unit would be selling price, that is we just had calculated 6 less the variable cost, so that will be the contribution per unit, 6 minus 4. Okay, the contribution, let's find the contribution now. So that will be is equal to the contribution per unit into the number of units. As simple as that. So the contribution is $2 lakh. The contribution ratio. Now the next thing that we are supposed to find. So we found the first one, contribution per unit, then the contribution and the contribution ratio. So that's going to be is equal to 2 lakh divided by the net sales, that is the contribution divided by the net sales will give us the ratio, and the ratio is 67% or 67.67%. So in this example we would have been given a fixed expense. We could also be able to find out the net profit of the firm. So let's get into the explanation of the contribution margin formula. See, contribution is a measurement through which we can understand how much a company's net sales will contribute to the fixed expense and the net profit after covering the variable expense. So while calculating the contribution, we deduct the total variable expense from the net sales, and doing that allows us to look at the fixed expense and net profit. See, contribution thus can be expressed in another way as well. We can easily say that the contribution margin over here, we'll just repeat the whole formula, D, and we'll say it will be fixed expense. Okay, this is another way of expressing fixed expense plus the net income. Okay, so that is another way of explanation, or you can imagine contribution margin in this fashion also. And in situations where there is no way we can calculate the net sales, we can use the above formula. So this formula is basically useful when we don't have net sales. So if net sales is not available, we can use this formula. So use of the contribution margin formula. You may ask why we need contribution. We need contribution to find out the break-even point, and we look at how contribution becomes useful in finding out the break-even point. Let's say a firm has a fixed expense as close enough to this is a new example. Let's take the firm has a fixed expense close enough to 1 lakh. The variable cost, let's say, is of the firm is 30,000. So we need to find the break-even point, BEP, which is also known as, we need to find the break-even point. So by using this concept of contribution, we can find out the break-even point. See, the contribution margin is what? Net sales divided by the variable cost. That is, we can also calculate as fixed cost plus net profit, right? So here we can write net sales less variable cost. We can write as net sales less variable cost is equal to fixed cost plus the net profit. Okay, so at a break-even point, the key assumption is that there will be no profit or no loss. Okay, that is called break-even. So net sales minus variable cost is equal to fixed cost plus net profit. So basically over here the profit we want as 0. As simple as that. Okay, so you can say net sales less 30,000, that is the variable cost, is equal to the fixed cost, that is 1 lakh, that is available to us, and the net profit is 0. So we have the net sales. Okay, if we just solve this equation, we get net sales as 1,30,000. So that is going to be our answer. That means 1,30,000 of the net sales the firm would be able to reach to the break-even point. Now we have almost calculated everything. We can also look at the contribution margin, what we have calculated in a much more sophisticated way. Now whatever we have calculated, we can just see in terms of template over here. You can easily calculate the ratio in template provided. The company net sales, the number of units sold 50,000, so the selling price is 6. The selling price of per unit is 6, and the variable cost is 2, so the contribution margin is 6 minus 2, that is 4. The contribution margin will be margin per unit into number of units sold, so that will be contribution margin will be 4 into 50,000, that will be 2 lakh, and the contribution ratio would be is equal to margin divided by sales, that is 66.67%. We have a contribution margin calculator over here, and you can use this calculator for quick analysis. So if let's say you have a sales of 2 lakh and a variable cost of, let's say, 30,000, so your contribution margin formula is net sales minus total variable cost 1,70,000. So in this fashion you can use this calculator to quickly find the data. Thank you.